Instead of leaving your hard-earned money in a bank or a regular savings account where it barely keeps pace with the inflation rate, investing lets your money grow and work for you even when you're not actively involved. It's about making your money do the hard work so that you can enjoy the rewards later on. The initial step is to figure out how much you can comfortably save and invest each month. A good guideline is to target investing at least 10 to 20% of your monthly income. So, if you earn $3,000 a month, that's $300 to $600 to allocate toward your future. It's about striking a balance between enjoying today and securing tomorrow. In other words, prioritize paying yourself first before bills, leisure, or impulse purchases. Here's the bottom line. Relying on a regular savings account won't suffice. Inflation gradually erodes your earnings, and stashing your money under the mattress won't make it grow. However, by investing, you unlock the potential of compound interest. So what exactly is compounding? Compounding is a process where the profits on an investment, including the initial amount and the accumulated interest or returns, generate extra earnings over time. Time is your ally in the investment world. The sooner you begin, the more time your money has to increase and compound. For instance, imagine investing $1,000 today in a compounding asset with a monthly contribution of $500 and an annual interest rate of 8%. In 2 years, you'd have $3,646.40. But hold on, let it continue for 5 years, and you'll find yourself with an impressive $36,689.30. If you're interested in learning more about compound interest, there are fantastic videos on compounding that can really help you understand. It's important to remember that everyone's journey is different. Avoid comparing yourself to others. Your investing path is as unique as your fingerprint. Some may begin with a larger initial investment, while others take small, steady steps. Your financial goals, risk tolerance, and investment choices are specific to you. We're all on diverse paths, and that's perfectly fine. Embrace your own journey and don't be influenced by what others are doing. Now that you have knowledge about investing, let's explore 10 excellent investment assets that you can start with today. 1. Cash. Indeed, cash is an asset as it's the most easily accessible form of wealth. Although it might seem counterintuitive to keep some of your investments in cash, it's a strategic decision that offers flexibility and security. Cash is often neglected in talks about investing, but it's a vital part of a comprehensive financial plan. While it may not bring the high returns linked to riskier investments, having a cash reserve acts as a safety net for unexpected expenses and chances. Think of it as the base of your financial structure. Keeping some of your investments in cash allows you to take advantage of opportunities when they come up. Market downturns or real estate deals may appear when you least expect them. Having readily available cash enables you to take advantage of opportunities, transforming financial challenges into strategic benefits. Yet, it's important to find a balance. While keeping cash offers security and flexibility, having too much can impede your journey to build wealth. As interest rates may not consistently beat inflation, having lots of cash can gradually weaken your purchasing power. Thus, the essential thing is to strike a proper balance by keeping enough cash for security and investing the remainder in opportunities that yield returns. It's about staying financially flexible without giving up the chance for growth. 2. Boring business. When we mention boring businesses, we're not saying they are lack interest. Instead, we're pointing out the often underestimated potential of small, steady ventures. Think about the appeal of small businesses that might not be in the spotlight but can provide steady profits over time. Consider exploring businesses like a service related to pets, a print-on-demand store, or even a social media consultancy. These may not be the flashy startups in Silicon Valley that make headlines, but they represent the core values of dependability and sustainability. A pet business, for example, taps into the enduring love people have for their pets, ensuring a consistent flow of customers. This industry has shown resilience, as pet owners consistently invest in their pets' well-being, from high-quality pet food to specialized grooming services. Another option is the print-on-demand business, a low-risk model where you don't handle any products. Marketplaces like Redbubble, Etsy, Merch by Amazon, PRL, and others take care of everything for you. They produce products as orders come in, minimizing excess inventory. The growth of e-commerce has made this a practical choice for creative entrepreneurs. Another promising business set to attract billions in the future is the digital products business, selling ebooks or online courses. While these boring businesses may lack the glamour of big tech, they operate with low overheads and can scale rapidly due to their stability, adaptability, and potential for niche dominance. This makes them appealing additions to your investment portfolio. Sometimes, the most significant returns come from ventures that go unnoticed. 3. Selective real estate is a concrete asset that has proven its value over time in wealth building. It's not solely about acquiring a house. There are diverse avenues to step into this market. First on the list is rental properties. Possessing real estate that yields rental income can be a game changer. It's akin to having an additional income stream that over time may even surpass the property's intrinsic value. Keep in mind, the location is crucial. Opt for areas with increasing demand and potential for appreciation. Another avenue is investing in small business commercial rental spaces. As businesses expand, they require spaces to operate, and you can reap the rewards of their success by owning the property they operate from. Lastly, if hands-on management isn't your preference, explore real estate investment trusts, REITs. These are firms that own, operate, or finance income-generating real estate. Investing in REITs provides exposure to real estate without the hassles of property management. It's akin to having a share in a real estate portfolio professionally managed. 4. Investing in basic agricultural land and consumer staples is a strategic move focused on fundamental human needs. The enduring demand for food and essential products makes these investments notably resistant to economic downturns. Agricultural land, when acquired strategically, can offer both capital appreciation and income through farming or leasing. With its finite nature, the increasing global population drives up the demand for food and land. Although not as glamorous as some investments, the stability and long-term prospects render it an appealing inclusion in a diversified portfolio. Wonder why Bill Gates owns over 200,000 hectares of farmland across the U.S. Seek areas with fertile soil and a track record of reliable agricultural output. Conversely, consider investments in consumer staples firms manufacturing daily necessities such as food, hygiene items, and household goods, offering a defensive approach known for its resilience during recessions. Even amid economic downturns, the demand for these products remains, rendering such investments less susceptible to market swings. While people might reduce spending on luxuries in challenging periods, essential needs endure, sustaining consistent consumption of these products. Businesses within this sector have the potential to deliver stable returns over the long term. Allocating investments to these sectors can establish a reliable income stream and function as a stabilizing force during economic uncertainties. 5. Investing in the healthcare sector, specifically pharmaceuticals and health supplements, is a strategic move given the enduring demand for products that promote well-being. With an aging population and increasing global health awareness, the pharmaceutical industry is set for steady expansion. Investors can explore opportunities with companies involved in drug development and manufacturing. Seek out firms boasting a strong pipeline of innovative products and a track record of successful drug launches. Companies that specialize in health supplements, offering vitamins, minerals, and wellness products, stand as potentially profitable entities in a time when preventive healthcare gains prominence. These firms often enjoy sustained demand, making the healthcare sector not only recession-resistant, but also a frontier for technological advancements. This makes it an appealing option for long-term investors seeking both financial returns and positive societal impact. Investing in art, though perceived as an endeavor for the affluent, can be a distinctive and tangible asset for the average investor. While not a conventional income-generating investment, art carries the potential for appreciation over time. Seek out emerging artists or pieces from established creators with a proven track record of increasing in value. Engaging in local art scenes, attending exhibitions, and researching market trends can aid in identifying potential opportunities. Keep in mind that the art market can be unpredictable, necessitating an investment approach with a long-term perspective. Diversification within your art portfolio can be considered to mitigate risks associated with the volatility of specific genres or artists. International investments and currencies open the door to various opportunities worldwide. When thinking about investing globally, go beyond borders and explore the global market. Look for established companies with a history of stability and growth on a global scale. Expanding your portfolio internationally not only protects you from economic downturns in specific regions, but also positions you to benefit from the growth of economies worldwide. Regarding currencies, see them as an extra way to diversify. Even if the US dollar is your home currency, consider putting part of your portfolio into other currencies, like the Swiss franc, CHF. Switzerland's reputation for financial stability and its careful fiscal policies make the Swiss franc a unique and historically strong currency. Adding such currencies to your portfolio not only guards against currency risk, but also taps into the strengths of economies with different monetary policies. Just make sure to stay informed about global economic conditions and geopolitical events that could affect the performance of international investments and currencies. This approach not only broadens your investment horizon, but also strengthens the resilience of your portfolio against uncertainties in any single market. In the realm of the stock market, it's crucial to grasp the influence of compounding over time. Investing in individual stocks lets you become a partial owner of a company, but it comes with higher risk and demands thorough research. Begin with well-established companies boasting strong fundamentals, a competitive advantage, and a history of consistent performance. For those seeking a more diversified approach, contemplate investing in broad market index funds or exchange-traded funds, ETFs. These funds mirror the performance of an entire market index, offering instant diversification across multiple stocks. Dollar-cost averaging, which involves investing a fixed amount regularly, is an effective strategy to navigate market volatility. It helps minimize the impact of short-term market fluctuations and capitalizes on market downturns by allowing you to purchase more shares when prices are lower. For centuries, people have used investing in gold as a way to protect themselves from economic uncertainties and inflation. Gold is seen as a safe asset because it holds its value during market turbulence, unlike traditional investments like stocks and bonds. While it may not provide regular income like some investments, having some gold in your investment portfolio can add stability. Gold has intrinsic value and is not influenced by the same economic factors that affect stocks and bonds. During times of economic uncertainty, such as market downturns or inflation, the demand for gold tends to increase. You can obtain gold in different forms, such as physical gold, gold-backed exchange-traded funds, ETFs, or gold mining stocks. Including gold in your investment strategy helps diversify your portfolio and provides a potential defense against economic downturns. Investing in the energy sector, especially in gas and oil, can offer profitable chances due to the world's ongoing reliance on these resources. As the global population increases and emerging economies grow, the need for energy remains strong. Investors can think about adding energy stocks or exchange-traded funds, ETFs, that focus on the energy sector to their investment mix. However, it's crucial to approach this area with careful consideration. Look for companies with sustainable practices, a commitment to environmental responsibility, and a focus on the future of energy. As the world moves towards renewable energy sources, investing in companies leading this shift can bring financial gains and contribute to a more sustainable future. Also, staying updated on geopolitical factors affecting energy prices is vital for making informed investment choices in this field. While the energy landscape changes, opportunities for growth and income persist for investors ready to navigate the intricacies of the gas and oil market. Remember, it's not about the initial amount, it's about starting and remaining consistent. Begin with small investments, learn, adapt, and witness your money grow.